The history of the stock market traces back hundreds of years and is closely tied to the development of trade, commerce, and capitalism. Over time, the stock market has evolved into a key pillar of the global economy, providing a mechanism for companies to raise capital and for investors to share in corporate profits. Early beginnings, the origins of the stock market can be traced to Europe in the Middle Ages, where merchants and traders gathered in marketplaces to conduct business. These early markets were informal and focused on the exchange of goods. By the 13th century, trading became more organized in cities like Bruges, Antwerp, and Venice, where merchants began using bills of exchange and promissory notes to conduct transactions, laying the groundwork for modern financial instruments. The first formal stock exchange is widely considered to be the Amsterdam Stock Exchange, established in 1602 by the Dutch East India Company (VOC). The VOC was the world's first publicly traded company, and it issued shares to the public to fund its expansive trading ventures. Investors could buy and sell shares in the company, and this marked the beginning of a formalized system of equity ownership. The concept of limited liability also emerged during this time, which protected investors by limiting their losses to the amount they invested in the company. The rise of stock exchanges as global trade expanded, other nations followed the Dutch model. In London, stock trading began in the 17th century with the establishment of the Royal Exchange in 1571. Initially, this exchange was focused on commodities, but by the 1690s, brokers were trading shares of companies, particularly in maritime ventures such as the South Sea Company. Stock trading became more organized over time, and by the late 1700s, the London Stock Exchange, it was formally established. In North America, the stock market took shape in the late 18th century. The first U.S. stock exchange, the Philadelphia Stock Exchange, was founded in 1790, but it was the New York Stock Exchange, NYSE, established in 1792, that would grow to become the dominant global exchange. The NYSE began when 24 stockbrokers signed the Buttonwood Agreement under a buttonwood tree on Wall Street. This agreement laid the foundation for organized trading of stocks and bonds in New York. The evolution of the stock market throughout the 19th and early 20th centuries, stock exchanges continued to expand globally, and the stock market became more central to the functioning of the economy. Major industrialization, particularly in Europe and the United States, led to the rise of large corporations that required substantial capital to fund operations and growth. The stock market became the primary means for these companies to raise capital by selling shares to the public. During this period, the stock market was primarily accessible to wealthy individuals and institutions. However, the introduction of the telephone and telegraph in the late 1800s and early 1900s enabled faster communication, making the stock market more efficient and accessible. By the 20th century, stock trading became increasingly popular among the middle class, particularly during the economic boom of the Roaring '20s in the United States. The stock market crash of 1929, the dramatic growth of the stock market in the 1920s, came to an abrupt halt with the Wall Street crash of 1929, which marked the beginning of the Great Depression. Overspeculation, excessive borrowing, margin trading, and a lack of regulation contributed to the crash. The ensuing economic downturn was severe, and the stock market did not recover for many years. In response to the crash, governments, particularly in the United States, implemented major reforms to stabilize the stock market. The Securities Act of 1933 and the Securities Exchange Act of 1934 were enacted in the U.S. to ensure greater transparency, fairness, and investor protection. The creation of the Securities and Exchange Commission (SEC) helped regulate the stock market and prevent future abuses. The post-war boom and modern stock markets following World War II, the global economy experienced rapid growth, and the stock markets expanded in size and scope. The New York Stock Exchange (NYSE) solidified its position as the world's largest stock exchange, while other major markets, such as the Tokyo Stock Exchange and Frankfurt Stock Exchange, rose to prominence in Asia and Europe, respectively. In the latter half of the 20th century, advancements in technology revolutionized the stock market. Electronic trading platforms were introduced in the 1970s, and the creation of the NASDAQ in 1971 marked the beginning of fully computerized trading. This made the stock market more accessible to individual investors, reduced the cost of trading, and increased market liquidity. The internet boom of the late 1990s brought even more individuals into the market, leading to a surge in retail investing. The advent of online trading platforms allowed people to buy and sell stocks from their homes, further democratizing access to the stock market. Globalization and stock market integration in recent decades. Stock markets around the world have become increasingly interconnected due to globalization and advances in technology. Many companies are now listed on multiple exchanges, and investors can trade stocks from different countries with relative ease. Major exchanges have expanded their operations globally, and cross-border mergers between exchanges have become common. For example, the Euronext was created in 2000 by merging stock exchanges in Paris, Amsterdam, and Brussels, creating one of the largest exchanges in Europe. Similarly, the NYSE merged with Euronext in 2007, forming one of the first transatlantic stock exchanges. Today, the global stock market includes dozens of exchanges, each playing a vital role in the global economy. These exchanges serve as critical platforms for companies to raise capital and for investors to grow wealth through the buying and selling of securities. The history of the stock market reflects the evolution of global trade, finance, and technology. From the early exchanges in Europe to the modern, interconnected markets of today, the stock market has played a key role in shaping the economy and facilitating economic growth. While it has experienced periods of instability, such as the Great Depression and various financial crises, it remains a central institution for wealth creation, capital formation, and investment in the modern world.